Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce and Associates Wealth Consulting, and welcome to Charts and Chat for January 18th of 2026. Have some economic data to review with you before we get into some more market-related items. Here we have inflation numbers broken down by headline, core, and then the various components of goods and services. So a quick check here, and the data series goes back about 10 years or so. You can see here we've got the pandemic, post-pandemic led inflation that we've talked a lot about, but both at the headline number and at the core number, we see that number trending down. Now, we've had some lumpiness in headline inflation owing to some of the more volatile components of inflation. But as you can see here, the latest data point came in at 2.7%. That was in line with the estimate. On a monthly basis, it was up 0.3%, and that was also in line. And so when you get down here to the core inflation on an annualized basis, 2.6, and that was a little bit ahead of expectation and to the downside, as well as the monthly data. So again, core inflation trending lower, headline inflation trending lower, but in a less linear fashion. And we migrate over here. We can look at goods inflation, which we know that we were actually in a deflationary environment for goods not too long ago, but we can see here that that seems to have leveled out at a very reasonable spot. We know that we have had a lot of service inflation. You can see that depicted here. Trend line again there is down as well. So overall inflation numbers trending in the direction that we want them to. On this chart, we have some of the key components of inflation over the last year. This is by no means an all-inclusive list, but some of the more notable areas, components of inflation. And as you can see here, over the last year, 2.7% overall inflation. And you can see some of these categories over here that you find in the supermarket, even though the grocery basket as a whole was very close to inflation, maybe slightly below. Eggs, which were coming off a very incredible rise in prices in 2024. This is just a natural correction off of that unusual high. But again, if you're on a lower income and you have maybe a fixed income, these categories are more painful to you than if you're in the upper income cohort. And this is why one of the reasons why the sentiment numbers have been so weak, because people are kind of feeling it in some of these key areas at the grocery store. And that's contributed to this kind of this K-shaped economy where we have sentiment numbers that are influenced by the lower income cohorts that are a lot weaker than actually what the hard data is showing us. And how the upper income cohort feels. But you can see here new cars, apparel, relatively benign inflation. But when you get into furniture, housing, vehicles, we had numbers that were outside of inflation. And again, mind you, Fed's target is 2%. And then I'll be here to tell you and have told you that I think it's going to be tough to get down to that point without a kind of a recessionary environment, but that's not necessarily a bad thing. If we get 2.5, I think everybody can live with that. And if you look back over the last 60, 70 years, average inflation has been around 3%. So I'd say 2.5, I think we would certainly take a victory lap at that. I just think it's going to be hard for the Fed to get down fully to that 2% on a very consistent basis. Probability of a recession continues to fall. There's a lot of optimism in the investment environments right now and in the economic thought sphere here that we've got. If you go back to October, that number is up close to 45%, and then now it's around 20%. And I say functionally 20% is kind of the lower boundary. You just really generally almost always see some positive percentage of recession, just because there's the laws of the unknown, and that the fact that people that are savvy about these things know that recessions usually happen because of some type of policy mistake, and that you know that these things oftentimes just don't come about on their own. They're driven by some catalyst. But clearly, I mean, especially over the last, call it 2.5 months, that we've seen a huge spike in confidence, I guess, if you will, in the economy. Here we have the latest in the Atlanta Fed numbers. You can see here uh, the Q4 2025 number. We're looking for economic growth, somewhere in the 5.2% range. That's gone up quite a bit, and that basically has gone up because it's been supported by a lot of positive data. And that's why I was talking about earlier that, the data doesn't really seem to be setting up for a recession, and that's a big reason why those probabilities are dropping. But a very strong fourth quarter is expected. Here we have some retail sales numbers, and again, positive data here. It was up 0.6% in November, the latest data available, and that was ahead of the estimate. And you back out automotive, and it was still up 0.5% or 0.5%, and that also beat the estimate. You can see trend line here. We had some really good prints in the summer in retail sales. It kind of trickled off a little bit, but came in strong. And obviously, we're expecting December to be relatively strong as well. You look at categories here. Again, and some of these categories, well, particularly gasoline, are categories that have seen price erosion just because oil prices have gone down, and this is a distillate of oil. But in some of these, retailers, building material, motor vehicles, clothing, you've got numbers that are some pretty strong prints here, well in advance of the overall retail sales number and then the ex-auto number here. So very strong data to end the year. All right, we'll talk about producer prices. This is also very important. These are input prices at the production level, and this is always something we look at to see what's the probability that some of these price increases, if there are increases, get passed along to the end consumer. What we find here is that headline producer prices up about 3% year over year. You can see that right there. And November, actually, we're using the left-hand scale for the annual number. So that's the 3% right here, and then the monthly number was up 0.2%, which pretty much in line. So if we go down here, look at core producer prices, those are also tracking right at 3%, and basically no change, flat for the month. But as you can see, we looked at consumer prices that were trending down in both the headline and the core. The opposite holds true for producer prices. After we've kind of we've equalized and offset the issues related to, to the headline that we saw, or excuse me, to the inflation that we saw a few years ago related to, the money supply imbalances that we had. Producer prices have actually, kind of moved up in a notable fashion. So we're obviously monitoring that. If you look at PPI at the core goods level, again, we'll break this down by goods and services. You can see that might be trending up a little bit. This is durable goods, and this is non-durable goods in the blue here. And again, rather noisy, but maybe a slight trend upward. We go down to services, and it's just really all over the place. The last print was actually negative, but the line of best fit here, if you look over a period of a couple of years, is probably somewhere in the 2 to 3/10 range. Now we get some regional Fed data. This is the Empire State Manufacturing Survey. So this is the New York Fed. You can see that it was ahead of expectations and trending a little bit higher. And showed you Dallas and Richmond in the last charts of the week. And so now we'll get some of the other Fed districts. And New York Fed looking pretty good. If you look at new orders, we've got an uptick there. So we have had some negative prints in the New York Fed district for quite a while, but the latest data, again, looking positive. Now we'll switch our focus our attention here on the Philly Fed. Again, positive data in the most recent reading, rather noisy on this monthly data. January was also well ahead of expectation. And then we go to new orders, same story. In fact, these charts look very similar in the sense that they're tracking almost exactly on top of each other. We'll talk about some other aspects of the economy. We've got credit card uh, interest rates, and you see here that those are really high. And so I bring this chart up because a lot of rhetoric in Washington right now about the Trump administration wanting to forcibly control institute caps on interest rates here, and you can see high interest rates are dovetailing here with increased delinquencies, and you can see here that we've got a lot more credit card debt outstanding. This is, you look at the economy, you say, what are the risk factors? Well, I'd say this is a risk factor because, if you've got card debt outstanding and you've got a lot of these people that are maxing cards out and they're becoming increasingly delinquent, this could be a source of, unwinding some of the momentum in the economy. But again, I show this because, and this in particular, because the administration is really looking hard, pushing hard for those caps, and of course, the industry is fighting back quite a bit, saying it would hurt profits, it would hurt credit availability, and so on and so forth. But this will be interesting to watch play out because the administration really wants to put like 10% caps for at least a period of time, and you can see here we haven't seen that in a long time. We'll look at capital spending. We've got non-defense capital goods. This is excluding aircraft, which can be very, very noisy. You can look at green line here represents new orders. That is trending higher. That's a positive sign. Again, that's been in development for a number of months now, and also shipments dovetailing with that. You can see the very close positive relationship between those two. So this helps build a lot of confidence in the economy, and at least the first half of the year here in 2026 because of the recent momentum here in capital spending. And it's also a positive sign from management teams that they're confident enough to want to spend, make capital expenditures, um, and they only do that when they feel confident about their business backdrop. Here we have growth estimates over the global realm here. We've got the US in the bright red, about 1.9%. Now this is trend economic growth. So this is looking, ways down the road here. We've got year ahead, 6 to 10 years ahead consensus. And so, this is, and of course, we just got the World Bank, their latest estimates. We got the International Monetary Fund, their estimates. They're all kind of falling in line here. They have been trending down over the last decade or so. U.S. at 1.9. You've got here. You've got the U.K. at 1.5, and then the other notable areas. We've got the Euro area about 1.1, and Japan's economy a little bit above the break-even line. I thought this was very interesting, and this kind of like goes back to the level of federal debt outstanding, and it's really more of a timing issue related to balance sheets and rollovers, and we're at a pretty amazing level here. I mean, we have a tremendous amount. You can see here a tremendous amount of federal debt maturing in basically about a year. You think about 26, about a quarter of all federal debt outstanding is going to mature in a year. And so it just means that we're refinancing at higher rates from where a lot of this debt was originally placed because interest rates have moved higher, obviously, since then. And it does, put some pressure on federal budgets because we now have, we now spend more on interest on the federal debt than we do on defense. And that number is like basically $1 trillion now. And so this is, these are going to be things that we're going to be talking about more and more often over the next several years. Now, something else I thought was very interesting here is money supply, and going back to 2021, money supply was very robust. We had the pandemic. There was a lot of checks going out. We were creating money hand over foot. Now, that reversed itself in 2022, 23, but then it's gone up ever since. And this is the silent killer, in my opinion. When you're trying to fight inflation, and we've had uh, some really good traction in inflation. We saw that on the first slide. Now, this is one thing that can undo that though, because when you add up basically commercial bank deposits and the assets under management of U.S. money market funds, then you get this trend line here. And so this is important to know that when you have increased money supply growth, or as defined by M2, that puts you in greater jeopardy of having inflationary stimulus. And in this case, what we're talking about is probably an offset to the positive trends in inflation we're seeing. So again, when you go out on the horizon past 6 to 9 months in the latter half of the year, this kind of issue takes or just introduces more uncertainty into the overall economic picture, and certainly into 2027. I think all bets are off right now for 2027, and that could be actually kind of a weaker year. And again, some of this might have something to do with that. And if you have money supply leading to inflation, then you've got a reversal in the Fed's basically in their desires, and they might be more inclined to raise interest rates next year if you have inflationary pressures that are coming out of this. Now we'll talk about the labor market. You can see over the last number of years, monthly change in jobs has steadily gone down. So this is a sign of kind of an economy that's kind of like, we're shifting, capital away from labor. And so job creation's not been as strong. Now we've had good unemployment data, which has eked up a little bit. But this is another issue. This came from a Wall Street Journal article over the past week, and immigration policies of the incoming administration have really dampened the supply of labor coming from immigrants, because that number is so low, and it's likely to be low, obviously for the remainder of the Trump administration here, and I think that's going to put a choke point on supply of labor. At the same time, we've got fewer jobs being created net net. Now, I alluded to this earlier, that we've got a slowing labor market. You can see the unemployment rate here moving higher. It's not at a crisis point, if you will. But what's interesting here is the age cohorts. You see 16 to 19. That seems to be the weakest market right now. And again, if you get on to 55 years and older, and your peak earnings years, you're not seeing that much of a change, but you're just seeing unemployment, and we'll see this too, that there are a lot of graduates from college, those with degrees, that do not have job, and that number's at a high point, and we'll see that in the chart a little bit later. And so, basically, you've got the younger age workers that are really contributing more to this overall unemployment rate. And of course, you have a lot of people that are in these years that are actually not participating in the market. So, you've got the participation rate a little sluggish. But, again, I think there are estimates that may entail the unemployment rate moving a little bit higher. But I haven't seen anything yet that kind of takes us to 5% or above without some type of recession. As you can see here, the what change that we did have in 2025 in the job market was really tied quite a bit to leisure, hospitality, and then the health services industry. Those were the real drivers, and not too surprisingly, with Doge and everything else going on with the federal government, that was rather weak. But we also see temp help going down, and some of these other categories also moving lower. But the real story in 2025 was health and leisure. Now we'll look at continuing jobless claims. This I would take as a net positive because this represents, really more of the long-term unemployment here, and that has actually moved down. And so you've got some positive trends in the longer-term unemployment area. Now, this data really speaks to what I was talking about earlier with basically the joblessness at the postgraduate level. So what's very, very interesting in this data is kind of the trend line on this is that you basically now have a quarter of the unemployed workforce that actually has a college degree. And if you went back to 2010, let's say, 15 years ago, that was only about 15%. And you can see going back to early 90s that's been a steady trend upward until, this is the pandemic hiccup, but then we've had a little bit of a tail higher. So there's obviously something to monitor, and it's created a lot of speculation over the value of a degree because a lot of these people are graduating with or have graduated with student loan debt. And we know that there are issues out there related to student loan debt and delinquencies there. It's also casting a new light on the value of the trade profession, where you're not going to have as much of that student loan debt to deal with, and you can still make a really good wage. But I was sifting through the data pack this week. I found this extremely interesting. Here we have some data on wages. Over here, you've got declining wages. This is from the Atlanta Fed. I would focus your attention really on the black line here, which represents the all-in number, and you can see that wages are moving lower. This is not necessarily great for workers, and this is not an outright decline. This is just a reduction in the rate of growth in those wages. So let's be clear about that. But we always want to weigh that against the cost of goods, the inflation level. And what we see here is even though wage growth is slowing, that we're seeing, again, is slowing, but we see prices down lower than that. And we saw in the first slide here that we've got, downward trends in core prices. And you can see that, we're in a positive situation now. We were not in that situation in 2022 when things were really upside down and we had significant negative wage growth. Now that wage growth on a net basis, net of inflation, is positive. Some news in the housing market. Here we've got affordability index, as we've shown you a few times here over the last several months. Really kind of in the doldrums. It's at a low point right now. And we look at single-family rentals. We can see here that basically in all tiers in this particular study that we're having a real drop or decline in rental growth, which is actually a big input into the core CPI. And so this is one of the things I alluded to in the first slide, saying that there's, in the absence of other factors or policy mistakes or what have you, that the natural inclination is for this to continue to help push inflation lower. And we got new home sales, which actually got a shot in the arm last month. We've seen some pretty sluggish data out of new home sales. We know that we've got builder incentives that are continuing. I've talked to at least a couple builders over the last week to 2 weeks, and they are definitely still buying down mortgages and providing incentives. So that's obviously an evidence here. We've got unit volume, which seems to be working its way a little higher. The last couple of data points were actually relatively strong. And then we've got median sales prices, which are coming down a little bit, but they're still high. If you look at, in the hundreds of thousands here, we still haven't retraced that rapid escalation over a couple of years ago, even as prices have actually come down and been in an abject way negative. So mixed data here overall in the housing market, but it's not as bad as it has been. We're going to talk about the National Federation of Independent Business Optimism Index. This is really the sentiment indicator for small businesses. And you can see that that's looking a little bit better, which is good. We saw some pretty weak prints here over the last couple of years, but the latest trend is certainly up. We've got more NFIB data here. This is the actual sales changes, which are still relatively muted, and I'd say they're below zero, so they're still kind of in somewhat contractionary mode. So small businesses are still feeling pain, but the expectations have certainly improved, and so that bodes well over the next 6 months or so. We have some bank credit data here. We're looking in this upper chart here. This is basically a ratio of bank loan growth year over year from small banks divided by the larger banks. And so see here that that's weak, that we see a little bit more acceleration in the large banks. You can see that down here low in the lower panel here. And good news is that that's moving higher. So credit availability to small businesses, which again, we just talked about, optimism levels are picking up. But access to credit is also picking up, and that's a good sign. We want that to happen at the small bank level because that's where most of the commercial and industrial or C&I loans are made, are to the smaller entities, and this is how the Middle America business community grows, is through credit that allows for expansion. So even though these numbers are moving higher, we want to see that ratio pick back up and have more volume and activity from smaller banks relative to the larger ones. I have a couple of oil charts to show you. We're still in the rough aftermath of the Venezuelan Maduro capture, and the initial dust has settled. Obviously, a lot of longer-term unknowns. I mean, we heard from a lot of the oil company executives that are actually a little hesitant to commit to reinvesting in Venezuelan oil production capacity because they've been burned at least twice before and had assets nationalized and expropriated. So again, there's a lot of headlines related to Venezuela, but I came across this chart and it really speaks to the power of the technological developments in the United States that have allowed for nonlinear and multi-directional drilling and unconventional drilling here that has allowed us to get to, basically over 20% in terms of the contribution of production from the U.S. to the global sphere here. And you see Saudi Arabia, while they still have a lot of oil in the ground, still a lot of proven reserves, their shares actually slipped, in part because the U.S. has been so aggressive and so strong. And Venezuela here, you can see at one point they were close to 4-5%. Of course, you got to go back, before the Chavez regime before you could really see some strong numbers out of Venezuela. But you can see here that that's basically gone to barely a trickle since. This chart, we have some U.S. data. We have the same red line here that shows production moving higher. This is 1 million barrels a day. Again, I don't know that I, at any point in time over the last 15 years would have ever guessed that we'd hit close to 22 million barrels a day. But again, technology has allowed that to happen. At the same time, consumption has moved higher, but not at the same pace. And so we're at a point of being able to, basically export more, which is what this green line represents. And, basically after the global financial crisis is when we started to see that export number continue to rise. Now, obviously, because we're exporting more, we need less. And again, there's some nuances here when you're dealing with light sweet crude versus the heavy crude, the sulfuric crude that comes out of Venezuela. And so refineries are geared to take certain blends. And so, I don't think you're going to see, imports completely dry up just because of those issues related to the refineries. And again, just to be clear, we're not building a whole lot of new refineries these days. So, but positive trends, production, you've got consumption that is kind of flatlining to slightly up, and then you have an increasing number of exports in that space. As a follow-on, I have these two slides here. This is very interesting as well. So, we've just shown you where production is picked up, but we've done it on fewer rigs. And this is the number of operating oil rigs in the Permian Basin. You can see that that's been a downward trajectory for a little while now, and it just means that we're more productive elsewhere and more productive overall. And the other issue at bay is the status of oil prices. This is Brent crude, which is similar to WTI, usually tracks a few dollars higher, but is a good enough proxy for us to use because the same dynamics are at play with WTI or West Texas Intermediate crude. You can see the latest change here is an uptick, but the overall trend has been down for oil prices. Interesting data chart here for Macrobond that we got through a lot of the supply chain problems a few years back. Here is a chart that shows this is the New York Fed Global Supply Chain Pressure Index. So this is basically respondents that are indicating that there are increased supply chain pressures. See that moving higher over a relatively short period of time. And at a time where we've got basically supply-driven PCE inflation becoming a little bit sticky at a higher level. And so, we'll have to watch this. This is, I think, early warning. It's not to say we're not going to have a supply chain disruption like we did in the pandemic when literally the economies were across the globe were shut down. But this could lead to increased input costs. It could take some of the steam and momentum away from some of the downward inflation pressures that we've seen. Again, just something we're going to have to watch. Here we have dividend yield. Now we're going to transition into investments and stocks. And so this is going back all the way to basically the early 70s and looking at the dividend yield of the S&P 500. And we can see that it spiked pretty high around 1980. This is a point of really high inflation, high interest rates. That has come down considerably, and we're down now around basically around 1.1% in the S&P 500 composite dividend yield. And so that just means that we have markets that have appreciated. Now it's not necessarily to mean that dividend yields or dividend rates have gone down. It's just that prices have gone up more than dividends have, even though we've got a lot of dividend issuance and stock repurchase activity. But it's just making the income component of equities less attractive right now. Now we'll talk about sentiment. We have the sentiment indicator here. This is a survey, Goldman Sachs. What's your view on risky assets? And you can see that we've had a considerable uptick in optimism. When you get down to these dark and light blue numbers here, which you can see here is it's a very strong trend actually, and as well as the declining negative trend from those who are responding as bearish or slightly bearish. It's a very optimistic environment right now. And I love to talk about volatility, and we've got two indicators here of volatility. VIX represents volatility in the S&P 500 or the equity markets, and the MOVE index represents the volatility inherent in the fixed income markets. And we have different time series here. This goes back to 2021. This is basically looks back at the beginning of 2024. And you can see equity market volatility is still pretty subdued. I mean, we've had some spikes that have led to some sell-offs, but it hasn't really created, we just don't have an environment where we have a lot of volatility. Now, on the fixed income side, this is what I've been saying a lot over the last year or so, that for a period of like 2 to 3 years, we had a lot more volatility in the fixed income markets than we did in the equity markets, and that's very unusual. But as we see here, volatility here in the fixed income markets has really dropped off to a level that we didn't see, that we haven't seen for a number of years now. And we do have more rate policy kind of relative certainty, if you will, and And so that's certainly helping this volatility move lower. So equity market valuations still very high, and we can see that we've got only a couple points in time here. Going back data, this goes all the way back to 1880, and I love these charts that go back like well over 100 years. It just gives you a full sense of the range of valuations, and I'd say we're pretty frothy. But again, we saw values increase in the S&P 500, over a number of years. So this just hasn't happened, but it's been evolving over a period of time with a little bit of dislocation around that shutdown of the pandemic. And again, this is the S&P 500, which I would caution is not the S&P 500 that was around here. I mean, has much more of a technology focus, perhaps less in the way of cash flow, certainly less in the way of dividends, and you get a lot more like momentum type growth in the index now. And we've talked a lot about equity market concentration. You can see that illustrated here. Share of the top 10 companies' market cap is in this amber line. We've talked about this a lot. But what's really important to note is that the share of the top 10 companies' earnings is also moving higher. So it's not, the PE ratios, I say in some sense, are not necessarily going higher because earnings are chasing it. And of course, there is a delta right here. It's a gap that's formed, going back, a number of years. But this is one reason why, with earnings growth and the share of the earnings coming from the top 10 companies that are helping to propel this multiple. But make no mistake, these markets are priced a little bit for perfection, and so any type of like breakdown in the equation is going to have a feeling. It's going to have an effect that we're going to be able to feel. Here we have more optimism in the market. You've got basically every single sector in the U.S. stock market that's above its 200-day moving average, and technically that is extremely profound. And then you've got basically 69.7%, or let's call it 70%, or a little bit more than 2/3 of all stocks are above their 200-day moving average. So you've got every single sector. But then within the sectors, you've got about more than 2/3 of overall stocks that are trading above their 200-day moving average. And this just tells you that there's a lot of there's some increase in breadth. It's not just the Mag 7. In fact, several members of the Mag 7 actually underperformed the index last year. So this is other elements of the market kind of taking hold, and we've seen at least over the last month or so stronger performance out of the cyclical stocks. We've seen stronger performance out of healthcare, out of communication, and some of these other areas that didn't participate as much heretofore. But again, very strong momentum type market, a lot of comfort, a lot of complacency, I guess. And this is just the right time to keep your finger on the pulse and watch things for developments. As I alluded to in the last slide, we've had several sectors that have done extremely well in a relatively short period of time, and we've covered a lot of relative gaps in performance here. So just look at this one: the industrials versus the overall S&P 500. Industrials have really closed that gap. They've done extremely well over the last month, as have materials over the last month. So these are two sectors that are being plotted relative to the overall index, and you can see the outperformance in each of those areas. And once again, to underscore the increased breadth in the market and the increased level of participation in the other sectors that didn't have as much influence over the last several years, I offer this chart. What we have here, you go back the last couple of years, you basically had 28 to 30% of the stocks that outperform the index. And this is the concentration factor that of the Mag 7, the AI, the hyperscalers, they got all the rave, right? And so they outperformed, and there were a lot of laggards, and a lot of people worried about that lack of breadth. Well, that's kind of turned around. So we've got almost 2/3 of the stocks that are outperforming the index, which, if you go back to this data series, it's like in the early 70s, you only saw like a couple of points here in time around 2000, where you had that kind of level of breadth in the market. Again, the 2000 was kind of a tough period, but in the overall performance numbers were negative. But like in an environment where the market is doing relatively well, this is a pretty powerful sign right here. We've got a few more interesting developments here. So here, let's look at high dividend stocks. And this is, again, relative to the S&P 500. Now, we've seen a lot of, like, again, some of the hyperscalers and those folks perform. They don't pay as much in dividends. Some of them don't pay really much of anything at all. And so the relative performance numbers were a little bit weaker over the last year or so, but that's turned around. The other thing that's turned around is this differential between small cap and large cap, and in particular on this chart, small cap technology versus overall technology. And when you consider the Mag 7 are all very, very large cap technology, and this is a very powerful sign. Now, this is here, you got to go back, and this is basically the Mag 7 just, crushing small caps. And you saw, the Russell 2000 really take it on the chin. But that has reversed, again, as has the dividend payers. So we're having a bit of regime change right now in who is leading the market, and I think it's very healthy. Here we have the S&P 500, overall index, but this is something else I want to point out too. We already talked about small cap technology versus large cap technology, but like in every instance here, we've got the percent of stocks that are above their 50-day moving average. Now, obviously, 200-day is a much more powerful signal, but 50-day moving averages are also very telling as well. And so this is what I want to emphasize here. This is the S&P 500 index. Again, high percentage of stocks outperforming the index. You go down to the mid caps, same deal. Small caps, same deal. This is very powerful. We haven't seen this in a while, and this has picked up over the last, basically the last, call it month or two. And but I think it's setting us up reasonably well for the first half of the year. Again, if earnings can keep pace and we don't have any negative stimulus, or the Trump administration doesn't do anything to kind of unwind the confidence in the market, i.e., an indictment against the Federal Reserve. If we don't have those types of things, I think, in that absence, I think stocks can continue to do well here, at least in the first half of the year. Here we got the Treasury yield. We'll talk about the fixed income markets for just a little bit. We've got 2-year yields that are coming down. This is all in some anticipation of rates being lowered. But again, as I mentioned very early on in this, if we get one rate cut here in the next few months, we should feel very happy about that. And again, with Fed Chairman Powell under attack and feeling, kind of like his back against the wall, I'm not sure he's going to be very inclined to want to promote another rate cut. But certainly the bond market is pricing that in terms of that. Now, what's really interesting is because the two-year rates have moved down, it increased the slope and the positivity of the yield curve. And what I mean by that is longer-term rates are higher, much higher relative to short-term rates, which is a very normal curve. They're very high relative, over a full percentage point on the yield curve expansion. So again, this is kind of a positive development. Again, there's more technicalities. There's, you've got your bull steepeners and your bear steepeners. And, when you think about, the 30-year rates really haven't moved that much. So this is just an anticipation of rates moving lower, driving that. Here we have foreign holdings of treasuries. There's a very interesting development here. You've got foreign official holdings flat, right? So we have the tariff tantrum. This has probably as much to do with China as anything else. That you're having China reduce its holdings of treasuries, but you have other buyers that are stepping in and filling that void. But private entities have really increased their holding, and we're going to need these buying entities to continue to step up, because when you think about it, we've got ongoing deficits. We're going to have to issue a lot more treasuries. And as I showed you earlier, we've got a lot that's maturing within another year that we're going to have to refinance and then add on new to support our deficit. And so we need these buyers to continue to step up, and they really have. And basically, in the absence of foreign interest or an acceleration in foreign interest, you've had to rely on these other buyers, these other institutional buyers. Corporate bond spreads. This is something you look at, and what it tells you is that we're not going to have a recession. Usually, you see these spreads blow out when we do have a recession. I don't have the recession bands overlaid here, but obviously you've got pandemic here. You've got 2008, 2009 when you had spreads that just absolutely blew out, and you've had periods of time where we've had some hiccups in the market where those spreads have kind of really blown out, but they're very tight right now. And this is absolutely 120% non-consistent if you think you're going into a recession. Well, the last couple of slides really relate to items of personal interest to me. Obviously, we've been talking a lot about AI adoption and what it's done for companies. I found this slide from Apollo to be particularly interesting here, because it's basically asking you, how has your firm's use of AI, impacted your firm? And what's interesting here is that, at least looking back over the last year, that a lot of people are like, there's not much change, or it's hard for us to analyze at this point. You've got your adopters that feel like there's been some definite benefits, that you still have the majority of folks that are still kind of wading through the nuances of AI to see how it's really going to impact them. And I think this number goes down when this survey is done this time next year, and it'll go down the year after that. But for now, there's a lot of spending, kind of fishing for potential productivity. And I think what this chart tells me is that a lot of people just haven't necessarily found it yet. This chart really speaks to adoption itself, and so this is from a research piece from Goldman, showing you that their current adoption rate is about 18%, expected adoption around 22.4 by the time we get to around the summer or September of this year. You can see, like, relative to September a year ago, that is a little bit more of a geometric increase, so positive. But as we saw in the last chart, there's still a lot of people out there that haven't really felt the difference yet, but I think it is coming. And I think the more adoption that you get, the more people are going to realize and feel what areas they need to deploy AI into, where it's going to give them the biggest bang for the buck. That's all we have in the chart pack this week. Have a great week. We'll talk to you again soon.